Hello everyone and welcome to this feature video with Nadal Rashid, and today's feature property is for 618 Brighton Road in Seacliff. Now this week's property is actually a property that was sold back in 2018. It's still under 2018 pricing. Unfortunately, due to a client of ours not being able to obtain finance, this property is now going to come back on the market. Now, the fortunate thing for the next investor is that this property is already built. It's a few weeks away from completion, so we're looking at 4 to 6 weeks for handover, which means there's not a lot of waiting time. And the best part is that the pricing is going to be the same as the price that was back in 2018 when it was originally sold. Now, this particular estate here or property is one of 8 townhouses that are going to be built on Brighton Road. The property that belongs to our client is lot number 1, which is the main one on the entrance, and generally they're the ones that are sort of the feature property for the estate. So this is where you can see my mouse over here. Now, Seacliff Park is obviously a very, very well sought after area. We've had some massive price growth there over the last few years. It's a beachside suburb. It's close to all the amenities. It's close to the city, close to the water, and it is a great buy in our opinion. So I'll run through the numbers with you shortly, but for now, I just wanted to give you an overview on the property. So just before I jump into the property, this is the site here. This is number 618 Brighton Road. So as you can see, it's just around the corner from Wheatland Street, which leads down to the beach itself. It's around the corner from your local shopping centre. There's schools nearby. It's walking distance to the Seacliff train station, and it's also walking distance to bus stops on Brighton Road. So location-wise, you can't go wrong. As you can see, there's Seacliff here, which is just a few kilometers down from Glenelg Beach, which is the main beach, and you've got Adelaide CBD there. So we're talking beachside suburb, great location, great potential for capital growth, and ticks a lot of the boxes for us fundamentally when we're looking at properties. So as I mentioned, it's one of 8. It's in a community, small community, which is on Brighton Road, and I will show you the property itself. Now, the property is obviously a 2-level townhouse. So on the bottom level, you've got a single lockup garage. As you can see here by the site plan, you've got the single lockup garage, and there is another car space in the driveway. Now, you can enter the house through the garage, or you can enter through the front door. If you do come through the front door, you've got the stairs to the side, and there's a little wet area to the front of the house. And then as you come through, you got your kitchen, meals, and living area with an alfresco under the main roof as well at the back. So definitely good use of the space here. And as you can see, as per the site plan, even outside, there is a decent amount of room for not just a pergola, but also a little yard, an open space, which will have, room for garden beds, a little bit of turf, your clotheslines, your rainwater tanks, and all the other stuff that goes outside. Now, when you come up the stairs, it takes you to a little landing area, and you've got the main bedroom, which is at the front, and that's got a balcony. It's a decent sized balcony. It's about 1.6 by 4 meters. The main bedroom has a big built-in robe, as you can see here, from wall to wall, and you've also got a private little ensuite. Now, the other 2 bedrooms are also generous in size. So bedroom 2 is 3.7 by 3 meters, and that includes a robe, a built-in robe in there. There is a shared bathroom, which has a bathtub, shower, basin, and toilet. And then bedroom 3, which is also decent size. You're talking 3.2 by 3 meters, also has built-in robes. So the property itself is full turnkey, meaning everything is included in order to be able to move in. That includes things like ducted heating and cooling, stone bench tops, floor covering. So you're going to get laminate flooring to the kitchen and all your living areas, and you'll have carpets in the bedrooms, all the blinds, stainless steel appliances, and dishwasher. It's fully fenced and landscape, auto panel lift door, NBN ready. So these properties are ready to move into, ready to go. So from a numbers point of view, what I want to do is show you what the numbers look like from a investment point of view. So again, based on today's figures, you'd be looking at paying more than 499 for this property. But for this example, and this is obviously an assignment of a contract for a purchaser of ours, you'll be purchasing it at 499. So that's the purchase price. Now, in terms of due diligence costs, we always allow $350 for a building inspection. That's just to make sure that the build is in line with what we are purchasing with a build contract, and just to make sure that any defects are covered in the first 90 days as well and rectified. Now, in terms of the settlement costs, I've based this example on a 10% deposit. So this is assuming that you've got $49,900 that you're putting in as a deposit. The stamp duty is calculated on the total purchase price, so it works out to be about 25 grand. And legal fees, I've allowed $1,000, although that'll come in around $500 to $800. In terms of loan costs, I've allowed $400 for setup fees. That's assuming that you're going to take a package. And if you have to pay lender's mortgage insurance, there's about $7.5 grand for LMI, which I factored in there as well. Now, there's no improvement cost because it's a brand new property, so you don't have to pay for things like renovations or extensions or anything like that. So that remains blank. However, I have included 2.2% for an agent's selling costs and $3 grand for advertising if you decided to sell this property down the track. So this works into our exit cost. Now, in terms of the financials, what I've done here is I've allowed $500 rent per week. Now, with properties in Seacliff, brand new properties are renting for a lot more than that. So we've allowed $500 per week, and we're also going to allow 2 weeks vacancy every year. Now, in terms of rates, I've overestimated on this a little bit. I've allowed $1,200 a year. It should be less, but I've allowed $400 a quarter. So $300 a quarter. So that way, that should cover the rates. We've also allowed $700 a year for building insurance. So that'll be a combination of building and landlord insurance. I've allowed $600 for body corporate. Now that's purely for the sinking fund that goes into the property it's for the upkeep of the driveway and any landscaping. So all of that will be factored in. It should be a lot less than this, but I've allowed $600 nonetheless. You're not going to have repair or maintenance or cleaning contracts or service contracts or garden and lawn maintenance. I've allowed $500 for a letting fee each year, and we've also allowed 8% for property management. So these are the annual ongoing expenses that we have to account for when we are purchasing a property. Now, in terms of the loan structure, I've done this as an interest only so I can show you the raw costs. Obviously, we can give you an example with principal and interest. We've based it on a 30-year loan term, not borrowing 90% LVR. And because interest rates are so cheap at the moment, I mean, people are buying properties for about, getting interest rates for about 2.7, 2.8, all the way up to, 3.5. So I've used some of the higher end interest rates I've seen in this example. So I've allowed 3.5%, but be mindful that this can change over the years. And the last section is the tax and market factor. So the first section of this is your depreciation. So as you know, with brand new properties, they depreciate on paper, which means you're going to be able to claim that amount off your taxable income per year. We also allow for CPI. So every year our costs associated with the property are going to increase by 3%. And what we've done is allowed a little capital growth of 5%. So being the CPI plus 2%. Now, the taxable income for this example, we've just based it on the average taxable income of our clients, which is $85,000. So you'll see in the example how this filters down. So if we go into the scenario report, basically what this tells us is if we are purchasing a property for $499,000 in 2020, over a 10-year period with a 5% capital growth, that means in 10 years' time, that property is going to be worth $812,000. Now, they say property doubles every 7 to 10 years. In this example, we don't even double. We're only making about $300,000 in capital growth. But if you average $300,000 over 10 years, that's still $30,000 a year you're getting in capital growth that you don't necessarily have to work for. Now, the second part to this is the loan and equity part, which basically says that the loan amount stays the same the whole way through the whole transaction. So we're starting with a debt of $449. in 10 years' time, we're assuming the debt is still 449 because the strategy on this example was a buy and hold for an investor, assuming that you have another property that you live in that you're paying down. So if you've got your own home, obviously you want to be paying that down as quick as possible because that's non-tax deductible debt. But since this is a tax deductible debt, obviously we, in this example, we've kept it interest only, and also to show you the raw cost of this property. So as always, obviously get accounting advice before you make any investment decisions around your tax implications. But that's just, based on this example here. Now, what happens though is even although the debt stays the same, as the value of the property increases over the years, what happens is you start to free up more equity. So in the first year, you start off with 49,900 in equity, which is the deposit you've put in. By year 2, you're up to 74,850 in equity. By year 4, you're at 128,000 worth of equity. By year 6, you're at 187,000 worth of equity. So what happens though is the bank wants to retain a portion of that equity for security, and they'll only release the remaining amount based on the LVR that you're set up with. So, for example, in this year where you've got 157,000 worth of equity, you'll have access to 96,000, which then means you'll be able to use that equity to then purchase more properties. Now, when we look at the rental income, based on $500 rent per week and allowing 2 weeks vacancy, that filters down to a 5% gross yield. Now, once you take out all your costs out of it, that's going to give you a 4% net yield. So when you look at the expenses, basing it on a 3.5% interest rate, that means there's $15,700 in interest, and we've got about $5,000 worth of property expenses. So all in all, that means we've got $20,719 going out and $25,000 coming in. So even before tax, this property is going to be cash flow positive by $4,282 per year. So without even doing anything, this property is going to put $82 a week in our pocket. However, because this is a brand new property, we've got depreciation benefits. So for those of you who don't know what depreciation is, as the value of items in the house start to depreciate, in particular things like appliances and carpets and blinds and all the new fixtures and fittings, that depreciated amount is a tax write-off. So in the first year, we're working on, say, $10,000 worth of depreciation. That becomes a tax write-off. But because we've made a profit, we can't use that full 10 grand because we've made a profit. What we can use though is a net amount of about 7,200. So if we take that off the taxable income of someone who's earning $85,000 a year, that means they're going to get an estimated refund of about $2,500. So that means that $2,500, which is a tax refund, plus the $4,282, which was positive cash flow before tax, means this property is now positively cash flowed by $6,873 per year, which is $132 a week. So really, we're achieving 3 things out of this investment. First, we're making about $30,000 a year in capital growth on average. We're making $4,282 a year in pre-tax cash flow. So even before we submit our tax returns, we're making $82 a week. But then by the time we've done our cash flow, we're now getting $6,873 per week. So it's giving us a 3-fold win in terms of capital growth, a good yield, and tax benefits. And mind you, this is a completely passive style of investment, which means you're not having to do any development, you're not having to do any renovations or subdivisions or any improvements to this property. It's doing this completely passively. So for those who just want to invest their money and let their money work for them, this is a prime example of an opportunity that we would recommend. I highly recommend this particular location because I believe Seacliff is a great area for investing and has been for the last few years as well. So if you would like more information on this, or you'd like a particular scenario run that's for your situation, please reach out to me either by replying to this email or just send us a direct message. I mean, we're all over social media and all over the internet. So feel free to reach out and we'd be more than happy to help out. So I hope you got some value out of this video. As always, I look forward to catching up and answering any questions. And as always, wish you the best, and I'll see you on the next video.